Okay, dear students, on request of some students, I'm going to record question number 4 of pre-mock December 24, only the hedging part. There is one IFRS 9 part is here. So let's discuss a short quick class for that issue. So now they are saying, as well as operating coffee houses, the first part of this question was IS 19 and this part is IFRS 9. It's related to hedging. Okay, so we are going to cover only hedging part. As well as operating coffee houses, Qasim roast and packages coffee beans and sells them under its new brand through supermarkets. So now they are making coffee beans and they are selling, so it's inventory for them. So IS2, right? So on inventory we are going to apply IAS2. On 1st December X5, see, this is the date when we'll start our hedging contract. Qasim bought 1 million kg of coffee beans for 4.54 per kilogram. Okay, so it's a recognized asset. They have bought it and it's in our book, so it's a recognized asset. Don't forget. To hedge the risk, see, there is a risk is there. Risk is the reason of hedging is there. To hedge the risk of a decrease in the value of the coffee beans, it simultaneously entered into a future contract to deliver 1 million kilograms of coffee beans on 31st December at March X6 for 4.95 per kg. Okay, so this is the future contract which we called as hedging instrument. See, hedged items are the real inventory. Hedged item is the real inventory present in our premises. Okay, the coffee beans. And hedging instrument, it is the contract. It is the future contract. Okay, and this contract will be settled on 31st March X6. And this is the rate. This is the rate they have fixed. Now the contract will be settled net in cash. Net in cash. See, this is the hint. It's a derivative. It's a derivative. Okay, this now you already know that hedging instruments are normally derivatives. And Qasim did not pay to enter the contract, so no premium is initially paid for signing this derivative contract. So initial value of this derivative contract is 0. So right now we are not gonna recognize on 1st December X5, we are not going to recognize anything for hedging instrument, okay, at first, because nothing we have paid. Qasim has completed all necessary hedging documentation and has elected to apply fair value hedge accounting to the arrangement. Okay, so all criteria, all conditions for hedge accounting is met. All conditions for hedge accounting is met. Now see, this is the year end. Now it's very interesting. This is the year end. At 31st December X5, Qasim still holds all of the coffee beans purchased on 1st December X5. Okay, so after 1 month still the inventory with us. And yes, you know the rules. You know the rules of fair value hedge accounting. At the reporting date, you need to bring both hedged item and hedging instrument to fair value with changes taken to P&L. Both hedged item and hedging instrument to be recorded at fair value, and changes, the gain and loss, will be reported in the P&L. Okay, right? Now on this date, the market price, see, this is the real world, the hedged item. In the market price of a kilogram of coffee beans, was $4.9, and the price available in futures contract to deliver coffee beans on 31st March X6 was 5.17. okay, so this is the fair value of hedging instrument. Now don't get confused. Although they have written the date of 31st March X6, why? Because this contract will be settled. Assume this 31st March X6 as the name of the contract. Name of the hedging instrument is 31st March X6. Okay, but right now we are physically standing at 31st March X5. So this is the valuation of hedging instrument and this is the value of hedged item. Now use your brain. Hope you remember when you guys did hedge accounting. In hedge accounting, there are two things. One is hedged item and one is hedging instrument. So we make the deal in such a way that if there is a gain in hedged item, then there will be a loss in hedging instrument. Or if there is a loss in hedged item, then there will be a gain in hedging instrument. So in this case, wait, I think there is a gain. Be active. Next week or after 10 days, you have your paper. So initially we bought inventory for, in the real world, we bought inventory for 4.54. And at the year end, you can see at the year end, the value of inventory is 4.9. So yes, in the hedged item, we have a gain. In the hedged item, we have a gain. But in the hedging instrument, we have a loss. How? We promise to sell somebody for 4.95. We promise to deliver somebody for 4.95 per kg, but in real market now the price is 5.17. But as we have promised, we have locked the price at 4.95, so still we have to deliver at 4.95, so it's a loss. In hedging instrument it's a loss, and in hedge item it's a gain. In hedged item it's a gain. I hope you can see it. So both things I will calculate. Even I'll make the double entry for you guys, and you need to write this description. So A part I'm not doing right now, A part, because it's IS 19 and I'm not covering IS 19 right now. I'm just doing IFRS 9 on request of my students. So this is B part. Using Exhibit 2 in accordance with IFRS accounting standards, explain with calculation how Qasim should account for the inventory of coffee beans and the futures contract. Okay, right? So first of all, 8 marks. Very simple. A little bit theory definitely is needed because you need to explain. So on coffee beans, IS2 will be applied. Okay, and initially it will be recorded at cost, definitely. And what is the cost? The cost is 4.54 multiplied by 1 million. Okay, into 1 million. So in 1 million there are normally 6 zeros, but we remove 3 zeros, so it will be 4540. Okay, and you keep 3 zeros on the top. Okay, so this is the cost. As coffee is a recognized asset and the risk is to manage the fair value, which can ultimately affect P&L of, what's the name of the company? Wait, of Qasim, right? That's why fair value hedge accounting. Remember the definition of fair value hedge accounting. It is applied on recognized asset or recognized liability, and the risk being that changes in fair value will ultimately affect your P&L. Hedge accounting is perfect here, right? Now, inventory is hedged item and the future contract is hedging instrument. Initially, fair value of hedging instrument is 0, right? Because the company did not pay anything initially, right? So this is just an intro. Now let's calculate the fair value change of both. First of all, give the heading of hedged item, that is inventory. Okay, so how you gonna do it? Fair value at 1st December x5, it's 4.54 multiplied by 1 million, so it's going to be 4540 as I just told you. And what is the fair value at 31st December x5? It's going to be 4.9 multiplied by 1 million, which is going to be 4900. So how much is the fair value gain? On hedged item, it's going to be 4900 minus 360. Okay, it's 360,000. So if somebody wants to make the double entry, the double entry will be inventory debit and P&L. Yes, yes, this is the magic of hedge accounting, that inventory can go more than cost here. So inventory debit and P&L credit is the entry for this. Just giving you time to just go through it. Okay, now let's calculate the fair value change of hedging instrument, that is the derivative. Okay, future contract. So what was the price initially when we entered in the contract? The price was 4.95. Yes, and then it's 5.17. 4.95 multiplied by 1 million, so 4950. And fair value of contract at 31st December x5, so it's 5.17 into 1 million, which is 5170. So how much is the loss? It's 220. Fair value loss. Okay, why it's a loss? Because we promised to give somebody at 4.95 price, but now the price has increased, so still we have to give at the low price, so it's a loss. It's a loss. Okay, right? So if you want to make the entries, the entry will be like this. See, for hedge item it's 360 gain, so inventory debit 360 and profit and loss credit 360, and the other entry will be P&L debit 220 and derivative liability credit 220. Derivative liability credit 220. Okay, so now you can see how much is the net gain. The net gain 360 minus 220 is 140. So you can write in the end sorry. Okay, so this is how you're going to approach it. This is how you're gonna approach it, right? Okay, let me again move the screen for you. See, so you need to write very simple discussion, very simple discussion about the standard. You can also write the hedge item, hedging instrument, the process of fair value hedge accounting. Both hedge item and hedging instrument are recorded at fair value with changes taken to P&L. You know why? Because the objective is to offset. Objective is to offset, right? Okay, now something related to the theoretical part, which is framework. See, using exhibits 2 and 3 with reference to the conceptual framework, for financial reporting, discuss whether the following provides useful information to Qasim's investors. We are not doing this part, the pension part. We are only doing financial instrument part. So Qasim's choice to apply hedge accounting to the future contract, right? And coffee. So whatever we did right now, we need to discuss that this hedge accounting, whether this hedge accounting providing useful information to the investors or not, or whether it is beneficial for investor or not. Okay, so it's very interesting, and you can just if you have understanding of this topic, you can write. Okay, so I have written just the pointers, and I will explain you. Just for first thing, see, this everything started on 1st December x5. Then there is a stop at year end, which is 31st December x5. And yes, in this question, practically in this question, we did accounting on 31st December x5 just for 1 month. But you know, the settlement date of this contract is 31st of March x6, 31st of March x6, right? So this is one period and this is the second period. Okay, right? But in the exam, in this question, we did till here. In this question, we did till 31st December x5. Now, so what are the pointers? Number one, this hedge accounting, whatever hedge accounting we did is excellent for risk management. Without hedge accounting, the company is at high risk. We normally fix our future. So the hedge accounting is used to reduce or mitigate or manage the risk. Okay, so which is good for investors may come to know about the risk management profile of the organization. Okay, number two, eliminates volatility. Yes, you know, in hedge accounting, both in fair value hedge accounting, both hedged item and hedging instrument, both are recorded at fair value, and the fair value gain and losses are cancelled immediately. So because of this, fair value changes goes to P&L and they cancel out each other. It eliminates the volatility. Now just use your brain. Let me explain you. Just think, we have one hedging instrument, the derivative. We have one derivative, and yes, derivative are always recorded at fair value, no matter you are not using hedge accounting. If you are not even using hedge accounting, still the derivatives are always recorded at fair value. So just think, if you are not applying hedge accounting and you have one derivative as per the question, so that derivative will produce a loss. That derivative will produce a loss of 220,000 here. But if you are not using hedge accounting, then inventory will be recorded at cost. And when in future you will sell it, you will book complete gain in the end. So what will happen? One period there is a loss and the other period there is a big gain. So this is volatility. Which normally investors do not like. which normally investors do not like, okay, right? So because of this hedge accounting, everything is smooth. So this is the second benefit to investor. Number third, yes, through hedge accounting, you basically fix your future. You lock the rate. You lock the rate. So when you lock the rate, you basically fix your future. So now investors are pretty sure about the future of the company. So now it is relevant. This hedge accounting is increasing the relevance of the financial statement. Why? You have done the framework. Relevance is one of the fundamental qualitative characteristic. And you know one thing is predictive value. Any transaction which is giving the predictive value is increasing the relevance. So yes, because of hedge accounting, we have fixed our future is secured. So it's giving a predictive value to investor. Okay, so this is the third advantage. Now, my dear student, as you know, in hedge accounting, both hedge item and hedging instrument are recorded at fair value. So in this question, especially in this question, your hedged item was inventory. So inventory is recorded at fair value in this question. In this question, it is recorded at fair value, and all the changes to be taken in P&L. Okay. So what is the advantage? The advantage of recording inventory at fair value means you are giving updated information to shareholders. That means whatever fair value is changing, you are giving the real time information to shareholders. And yes, one more thing, when you are giving the fair value to shareholders, so shareholder can predict that what is the cost of buying such new inventory right now. Okay, so that is also one advantage. That is also one advantage, right? Okay, then one more thing, recording. Now this is the criticism. Recording inventory at fair value may reduce comparability. Yes, for example, we are doing hedge accounting, so our inventory will be recorded at fair value, but there is a company, our competitors, they are not doing hedge accounting, so they will definitely record inventory at cost. Now think, our inventory is being recorded at fair value, but our competitors inventory is recorded at cost. So this comparison is, these two books are not comparable, right? So this thing may distort comparison. And one more thing, just think, when you have a fair, in this question which I just did, the practical part, there was a net gain of, I think, wait, how much? Net gain of 140. Yes, there was a net gain of 140 in this quarter, in this PNL there was a net gain of 140. So all the shareholders are not chartered accountants, they are not highly educated. So some of these shareholders may perceive this 140 in such a way that we are doing high volume transaction, we are doing some extra sales, or we are doing some extra good things, which is not the case. Okay, so this may give a wrong indication to shareholder, a wrong hope to shareholder, that our business is performing something extraordinary. In reality, the operations are normal. And the last but not the least, yes, hedge accounting is complex. That's why I'm teaching this question. I'm not teaching this full question. I've just picked. I have just picked question number 4, pre-mock question number 4, and only the hedging part I have picked, because I know there are some students, they feel difficulty in this. So yes, when it is difficult for students, the chartered accounting students, so obviously it is difficult for a common man as well, for an investor as well. So hedge accounting is complex. So there are some understandability issues. They can't understand the net gain of 140, and they can't understand the hedge item and hedging instrument. So we call it this is understandability issue. That means just to increase the relevance, we are compromising understandability. Just to increase the relevance, we are compromising understandability. So my dear student, I have given you some very good points, good stuff. If you write this, you'll get good marks. But the most important thing, I say again, confidence. Keep confidence on yourself. Okay, so if you are confident, you can do it. I hope you understood everything. If you like it, please comment on this video on the YouTube, and also subscribe my channel. You can share this video with your friends, and You can also watch the other videos. There are other videos as well on my YouTube channel. Okay, so thank you, take care, and bye bye.